traders, Gary Wagner here, just about 11 o'clock in Honolulu, 5 o'clock in New York on Monday, Cinco de Mayo, the 5th day of May 2014, and this is the daily report for gold and silver. We are continuing on an uptrend with precious metals moderately higher pretty much across the board today. We're looking at gold currently trading, call it 1310, 1309.94. Puts it up about $9-10 on the day. Now the high is 1317, the low 1304.30. Have we awoken the precious yellow metal? I don't really know. Up about 14 cents today, low 1941, high 1981. Current 1962, as I said, puts it up roughly 14 cents on the day. More on silver towards the end of the show. Of course, as always, this video will focus on the technical aspects of the precious metals market, specifically gold, as we leave our fundamental analysis typically to our letter. But really, when we look at the marketplace today, it can be described in two words, I believe, and that's safe haven. With the unrest going on in the Ukraine, and we talked about this over the last couple of weeks, that this was really going to be the wild card, we could see safe haven investments returning in gold, because when you have geopolitical uncertainty, there really is no substitute right now for gold. We do have it higher, and most importantly, we have the market trading above 1300 right now. Now, we talked about on the fact on Friday that we're probably going to go ahead and raise our stops. I will send out a special trade alert. I want to study a couple of the lows and see what kind of follow through we get. Now, in terms of current levels of resistance and current levels of support, the real level that we're looking at, it's a minor level, but nonetheless a level, and that's 1312. I'm basing that on this one fib extension, and 1312 is a 38% extension of that. Our next real level as we look at the market has to be this top right in here. It's also a 50% retracement. When I say it's a top, this is where the market kind of fizzled on that B wave, going A, B, looking at this as possibly our C wave, or even here as our C wave. Irregardless, we do have a series also of higher lows on these last dips, and that also is pretty significant on the upside. But the best way to really see this is to look at our daily chart. And when we look at our daily chart, these last couple of moves in the market are pretty evident and pretty clear cut. Consider this. We know we had this nice long $200 rally, and I believe that this was our wave one right here. I believe that we probably concluded wave two and are moving into our third impulse wave. Now, if that is the fact, we probably will go through a series of 5 waves, and realize this is all a sub count that we're looking at. This isn't the major or even the intermediate. We're looking at the smallest of the moves, and these are the moves we'll typically trade off of. But again, we are pegging our resistance short term just at 1312. 1317 was the high. But as you can clearly see, we're trading right now at around 1309, so just below that. I don't see that as a really hard obstacle to overcome. The real resistance is this former top sitting at around 33. That's the point we really want to see it take out. Now, we're in at 92, and the thing is that we've had a couple of choppy trades through the beginning of the year. And what we really want to do is, if we are going to catch a sizable move, in other words, if this market is going to take off, we're going to see some sort of a sustained rally, even if it's $100, $150, we want to be able to capture as much as we can, because what I found over time in terms of trading strategies, it's those big trades that really make the difference when you look back on a year. So next real level, 12, then after that, 33. You know, sometimes it's harder to actually read as these wave changes sometimes are easier than others. Reason for me saying that, I've put up our 3-day chart. I'm going to convert it into a 2-day chart and maybe even a 1-day chart. And the rationale behind it, we can see how clear-cut this uptrend was. But as this market came down, we don't have, at least on our 3-day chart, a real consistent jump. We'll probably have to go to a 1-day chart. Let's go ahead and do that. And when we do that, you can see this has now been converted to just a straight daily. Each candle represents 1 day in time. When we look at it in this way, we can see a couple of things. First of all, a band of support in this area. Now, when I say a band of support, I'm looking really at the bodies on these Japanese average, because Quite obviously, we've had a considerable amount of lows that came in below that point, but I'm talking about the open and closing range on a standard candlestick chart and the range as it compares to the midpoint on a Japanese average chart like this. The other thing is that when we look at this one-day chart, we see a couple of things. First thing is this is the second stab at a rally. We had this first stab. We recall that. We had the market slightly correct. I believe the low was 68, and then it comes back up like this. Now, we do have actually a clear breakout in terms of a resistance line, and let me show you what I'm talking about here. On a shorter term resistance line, when we take a look at the particular tops in the market and draw our line from there, we can see that we absolutely, in my opinion, based on this technical information, have had a clear breakout above this very, very short-term resistance line. That's very good. What's our next target? What's our next point? It's really got to be 1333, 1331 in that area, because it's this band that makes up this last top that we got. Let's draw that in. And of course, that top is right in here, and that's what we got to see, right here, and that's what we've got to see taken out. So when we look at this market, this is a 2-day chart. We've been attempting to put some sort of an Elliott wave count in this. This is where we're keeping our most active count. And my belief is, as I said, that we've probably started 3 at this point. We held a particular level that we were looking for. We came $5 from 1262. That was really where we represented the lowest we should see this market go to on the way down. I do believe, in terms of a bigger picture right now, let's go ahead and change the color. I don't like to use red as much, but we'll go ahead and use a blue or something. But I do believe that this is the conclusion of our primary fourth, major fourth. This is our major third, our major second, of course, our major first. And so I do believe that we have a real opportunity that we are going into a primary fifth, and a primary fifth's a really exciting endeavor because it's a two-year cycle minimum in which, if in fact this model is the way this market unfolds, we're looking at the market traveling back to really uncharted territory, except for one moment in time, and that's this moment in time between 2009 and 2011, when we saw the market go from 1200 to 1900. We've seen these price points on the way down, but we've only seen them on the way up on one other occasion, and that occasion is right here. So these could in fact be some very interesting times, some very exciting times in the market. I don't see that we caused any long-term damage as this market came down, and quite honestly, when we look at it at this point, it seems to be not so much textbook, but it seems to be a market that is destined to move higher based upon our Elliott wave model. Now, of course, before we get too excited and ahead of ourselves, we've got some barriers that we really need to get through before we can say with any kind of certainty or high probability in terms of the technical evidence that this is in fact what we're looking at. This is one of the charts I believe we really need to see make the play. Now, we talked about the fact that as this market traded lower, and this of course is a classic Andrews pitchfork, we've got our center point or our handle, our 0 prong here, our 100 prong here. It's created from 3 data points. This low, 1535, this high, 1800, and one other high. The high that creates the handle is 1900, the all-time high. Market comes down, it never breaks out of the 0 prong, nor does it go below that 100 prong. That's the nature of the Andrews pitchfork. And you can see quite eloquently that it was a highly resistive area here. Market comes down, we find support here. Market comes back up, we find support at this 23. Here we find support at our 38, and so forth. Market comes up the first time in history since we put this chart up. It actually breaches above, very, very short-lived. Comes back down, finds support at 23. It needs to move above and cross above this line if, in fact, we are out of the woods in terms of a bear market. Really, until it does that, we do not have the technical evidence we need to say that this is not a counter trend. This still could be a counter trend because we need to see it move to certain areas to define breaking out of that bear market and into a bull market. One of those was, simply put, when the marketplace broke through the long-standing resistance line. That was the first thing that we did, and that resistance line was basically drawn from way up here. But if you followed all of these highs down, this was the first time we actually got an extreme breakout. It's still well above that. That was the first thing we had to see. The second thing that we had to see was it break above this. It did do that, but it just retreated back up. We need to see it not only break above that, but start trading in a new range. And at that point, traders, we can actually X out this particular study or move it or change it. We'd probably create an Andrews pitchfork that's moving to the upside because we'd be in an up channel. But traders, this chart has been in my arsenal, so to speak, my chart arsenal for far too long. I want to off this chart as quick as I can, and I can't do it until we get a decisive, effective break above it and trade above it for some time. So what about silver? Silver's had a nice move. 1. 2, it is above 1958, ever so slightly, but it is above that. That's a critical number for me. But traders, I can not say with any kind of conviction or certainty that we have seen anything on a technical basis that's telling us we're out of this muck. And what I mean by muck is a narrowly defined trading range in which the marketplace has got about $1, $1.50 spread, 19 on the low, 20.50 on the high, $1.50 spread. Of course, we did have the market kind of really play above that. That was short-lived when you consider this timeline being about a little almost over a year, December, all the way up to, call it 8 months, 9 months. We have seen this market just trading in this defined range. It really hasn't been able to break out, and I don't see any reason that that's going to change. I could be wrong. I could be wrong on this, but my sense has been, and this is why my recommendation was, if you're currently a silver trader, I recommended the last 2 weeks that at least for this trade, you switch it over into gold. We're looking at silver, but I'm hoping that my silver traders have their money in gold and they're profiting like our gold traders are. I want everybody to profit on this trade. I think we've got the shot of having a nice trade behind our belt if we see this rally continue to mount steam and effectively stay above 1300. That's going to be the key, and that's going to be the deciding factor on where we move our stop up to. This is Miguel Wagner wishing you as always good trading. We will talk to you tomorrow for another daily update and review. Bye-bye.